You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Coffee with Cott, where advisors can find out what is brewing in the options space with your host, OIC's Director of Education, Eric Cott. OCC was created in 1973, and OIC is an industry resource supported by OCC to provide trustworthy education about the benefits and risks of exchange-listed options. Since 1992, OIC has been dedicated to increasing the awareness, knowledge, and responsible use of options by individual investors, financial advisors, and institutional managers. Before we get started with this show, investors should know that options involve risk and are not suitable for all investors. You should never enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margin interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as recommendation to buy or sell a security or to provide investment advice.
Welcome, everyone. I am your barista for this program. So glad you can join us. Please go ahead and fill up your cups with a hot beverage of your choice. Whether you're cold brew, double espresso, mocha, cappuccino, grande type, we have you covered. On this show, we pour over topics that relate to your practice, your clients, and options. Welcome, everyone. I'm Eric, your head barista here at Cafe Cott. Spring is here, and April 15th is looming, and as some would say, a day Americans dread. Tax day, unless you're a tax preparer or a CPA who actually love this time of year. But I'm going to give a small shout out to my preparer, Ken. But don't stress, my coffee compadres. Today's podcast is going to clear things up for you, thanks to my two colleagues and guests today. Before I introduce them, no, I'm not going to sing Taxman by the Beatles or the Johnny Cash song After Taxes, mainly because I would embarrass my daughter Talia, who's an accomplished musician. Today's podcast is titled Taxes, Options, and How Advisors Should Approach Strategies with an Understanding of Potential Traps and Opportunities. Now, let me introduce two beacons of the option world. Many of my listeners probably know and are very familiar with these gentlemen because they're authors, they speak around the country, but most importantly, they enjoy coffee and covered combos as much as I do. Robert Gordon, or Bob Gordon as he likes to be referred to, and Russell Rose. So Bob, let me begin in the Big Apple where you call home. You're a professor, kind of a Renaissance guy. You've got many roles in the securities business. Please share a bit about your investment background.
Well, I've been a broker and I've been a branch manager, and I think I found that I had no skill in picking the direction of anything. And at around the same time, options and futures were just starting to trade. So we're talking about the mid-'80s or so. And looked at it as sort of a practical application of math and jumped into it, and have used futures and options to help clients implement their investment strategies since then.
And Bob, you have been in the industry. I'm going to kind of not mention age here because I want to be appropriate, but let's just say it's been multiple decades.
Yes, I've had my firm 21st Securities since 1983, and I was in the business for a period of time before that.
Well, we're fortunate to have you. And Bob, as you know, you've done a lot of things with the OIC, and we're forever grateful for that. So now I'm going to go to the home of the Cubbies and the Sox because I'm not really sure. I know a lot about this individual. He's sort of my second city colleague. And Russell Rhodes. Russell, I was about to say that you were from such and such exchange, which I think a lot of our listeners relate you to. But please go ahead, tell us where you are and this fairly new role.
I'm formally of the SIBO, where I was running the Options Institute up until July of last year. And, if you knew me as well as you let on, you would have said home of the Sox and the Cubs, and you said Cubs very quietly. I left SIBO over the summer. I joined Tab Group. I think everybody's familiar with Larry Tab and Tab Group. Been around for almost 20 years. I've taken over the derivatives research practice, where I focus on all markets, not just equity and index options like I did in the past at SIBO, and am enjoying the challenge tremendously, really focusing on a broad spectrum of things. It's keeping me busy the past few months. And in addition to that, I'm actually an executive lecturer at Loyola University here in Chicago, where the students were paying less attention to me and more attention to basketball this time last year. I'm kind of glad that didn't. Honestly, it's made my life easier in the classroom that they didn't repeat that.
Well, we were talking NCAA on the last podcast. This podcast, having two academics, both you and Bob, really kind of add to this discussion because it can be quite complex. So, Bob, let me start with you. The topic, tax treatment of options. So in most cases, Bob, when you're figuring out taxes on regular stock investments, we like to say it's a fairly simple process. You either pay taxes on the gains, you deduct the losses to a certain degree. However, when you're calculating taxes where options are involved, it's an entirely different flavor altogether because, options involve more complex transaction. The IRS applies some special rules we need to know. So let me begin with you, Bob, in terms of tax treatments. If we begin with an example of, say, selling a put, and then maybe an example of, say, selling a call.
Well, I guess as it relates to those, one of the issues would be whether you're selling them naked or selling them covered. But let's do the put first because those are usually more naked sales. And when you sell something, it's considered to be a liability rather than something you own. And that's why most short sales and sales of options are always taxed as short-term gains. The caveat would be that when you're using index options have their own taxation under what's called Section 1256, and they're actually taxed as 60% long-term gains and 40% short-term gains automatically. They're also marked to market at the end of the year. But if you were going to be selling a put, it's normally going to be taxed as short-term gain no matter how long it's held, unless you were selling a put on an index. Selling calls is quite a different story because if you're selling naked calls, then it would be taxed the same way as selling the puts we were just discussing. But if you were selling calls on stocks you own, which are considered to be covered calls, then it gets much more complicated and it starts being married to the price of the stock, and it could create what's called a straddle or not, depending on how deep in the money the options is. And you could probably write a chapter in a book about what happens when you're selling covered calls. Naked calls are easier to discuss.
So let me bring Russell in here on that topic as well, because both of you have written before. And Russell, I know you've traveled as well, not only talking to retail investors, but the audience here are advisors and trying to disseminate some of the misconceptions around this, but also the vernacular in terms of this tax implication. And I know Bob just touched on that. So maybe asking you, Russell, about the covered call, and we can talk a little bit about this qualified covered call as well.
Sure. when you're, basically you've got the over-under that always comes into account, the more than a year and less than a year as far as long-term capital gains or losses goes. And that comes into play more often on the short end of things because just about everybody focuses on shorter dated calls, whether they're doing a covered call or they're doing, some sort of long option position as well. And the treatment really is based on, what I think it's almost kind of like what is your intent and how long have you been holding the underlying as well when you're doing a covered call.
Bob, in terms of the covered call, and I mentioned to Russell about this QCC. There are different sets of rules. You even touched a little bit about the straddle rules and the holding period. So in a way that an advisor might be able to quantify this or understanding, there are different holding periods, there are conditions. How to summarize that as it relates to for the advisor?
Well, it may help to just step back a second and see why the government put these rules in. So there were people that were running dividend capture strategies where you would buy a stock and you would sell a very deep in the money call and protect yourself and still pick up the dividend on a tax-favored basis, and the government didn't like that. So they basically came up with a set of rules that said if you sell a call and it's not a qualified covered call, then it will not give you the proper holding period for the dividend to get you a tax break, and will also create something called a straddle. And generally, the call has to be out of the money. And then they even got more complicated with saying that if the option was for more than a year, it not only had to be out of the money, and they define out of the money as above the price that the stock closed at the day before. If you read an option that's more than 1 year, then you're supposed to take the closing price last night and increase it by 2% a quarter. So if you wrote a call that was 364 days out, it could be just, a penny or two above last night's close. But if you wrote a call that was 366 days, it would have to be 108%, keying off of 108% of last night's close. And then each quarter you go out, it keeps increasing, and the options can't be for less than 30 days or more than 33 months. So someone who writes covered calls that are less than 30 days, thinking they might pick up more time premium, may actually be screwing up their dividend. And it can't be more than 33 months either. To try to make it easy, we do have a tool on our website, which I find gets probably most of the traffic that comes to our website, and unfortunately it's from other brokerage firms. But it's a little thing you could click that says, are your calls qualified covered calls? And you could put in last night's close and how long your options are going to be, and it tells you the strike price that you have to use in order for it to be a qualified call and not screw up the taxation of the dividend or create a straddle.
Well, Bob, I have to admit, and I want to bring Russell in because I have to admit, I have used that decision tree. I mean, again, it really is something that provides a fairly straightforward opportunity to determine your underlying, the closing price, how many days when that option term is going to expire. And Bob, correct me if I'm wrong here, sort of that purpose of the call, right? Whether you're hedging position without a straddle, whether your dividends are involved, or if it's going to be a long-term game. Is that correct?
Correct.
So,
correct.
And Russell,
and there's a little article that describes what the rules are, but the rules are just so ridiculously complicated that we found that the best way to do it would be to literally just stick this decision tree on there, and it's really just an Excel spreadsheet that you click into, and as I said, I think it's just the rules look more complex than they are. Once you stick them into a spreadsheet, they're pretty simple.
Russell, I want to bring you in because that complexity term comes into play. And not only do individuals, I mentioned early on, think that taxes are complicated, and clearly 2019, they were supposedly becoming more simplified for the U.S. tax filer. and maybe there are some things that are going on in the tax code relative to derivatives. But let's keep our focus here, because I think you wanted to share something on this qualified covered call.
Oh, yeah. Well, Bob hit on it a little bit, but just about you need a tool. That's the best thing to say here. And thank goodness he's putting one out there, because not only do you take time into account, but if the stock has rallied an awful lot the day that you're selling the call, you actually have to adjust what your definition of in the money is. And the previous day's closing stock price changes the rules as well in a lot of different increments. I think there's 6 different increments. Where like anything that's under $25, 25 to 50, 50 to 150, and then greater than 150, and then other types of things that come into play. But this is something that I would not want to do with, I think part of our mission as far as people that go out and talk about derivatives in front of everybody is to make sure people don't make mistakes. And often people feel like they're 95% sure about something, but they want somebody to tell them they're 100% sure. And I qualified covered calls, I think totally falls under that as something that you might think you got it all right, but it's really nice to have something online that tells you that you've got it correct.
So let me,
Eric, it's just something to throw out here, because it is tax time, which is, I think, of interest, is that the brokerage firms report that a dividend is a qualifying dividend if you owned it on the record date and even if you held it for 1 day. And the rules are that you have to hold it for 61 days, and the 61-day holding period could be messed up if you bought a put on it or if you sold a call that wasn't a qualified call. But the brokerage firms are not the policemen on this. The taxpayer is supposed to be. So if you did own a stock and you received a dividend and you wrote a call that wasn't a qualified call, it's still going to be reported on your 1099 like it is a qualified call. And the client or the client's advisor is supposed to know that they fell into this trap. So it's really sort of a little bit of a bigger problem, because the information you're getting on the 1099 is actually, might not be correct as it relates to whether the dividend is qualified or not qualified, because of these traps you could fall into by either buying a put or by selling a call that isn't qualified. So people have to realize that a 1099 isn't the gospel. It's really just the beginning information that you're supposed to be working from.
It's interesting, Bob, and I'm glad you brought that up, because, it wasn't so many years ago, all three of us know this, and having in my prior life been an advisor at a very large firm, as I always like to say, that has a bullet as their logo, I remembered that it was the responsibility of the client along with the advisor, but in terms of, cost basis was not something that was tracked or implemented, and you kind of, used certain different Excel spreadsheets and calculated, buybacks and all the things that used to go on. So, here we are, as you said, with 1099s not being, the gospel, it is something that is important for the advisor to convey that message to their clientele and be aware of that. So we know, let me go this direction in terms of there are misconceptions, and I'm going back to a prior blog that this is sort of a selfless commercial for our blogs that are out there for Coffee with Cott, but we talked about misconceptions, in the options arena. And one of those is that most options expire worthless, which we know they don't. They either get rolled or they're closed. And so, Bob, relative to expirations, when a stock option expires, it closes the trade. The writer or the holder have to determine the gain or loss by, sort of subtracting that purchase price from the sale price. Are there some rules that govern this in terms of short or long-term capital gain designation? And this again, coming back to this idea of 365 days or less, and that determining the short-term gain or loss.
Well, if you owned a stock and you wrote a call that was a qualified covered call that doesn't stop the holding period, etc., and the call was exercised, the price you're selling the stock for is the strike price of the option plus the amount of money you brought in for the option. So if you owned XYZ and sold a call with a strike price of $35 and took in $3, if at the end of that the option expired worthless, the $3 that you received probably would be a short-term gain. Would be a short-term gain because you sold it for $3, it expired worthless, and that would be it. On the flip side of it, if the stock was at above 35 and the option was exercised, you received 35 from the exercise, you received $30 from selling the call, months earlier, but the actual sale price is 38. And if the stock was held for more than a year, then all of that turns into long-term gain. So again, it's sort of odd because if the option expires worthless, it's short-term, but if the option is exercised, the money you took in from the option is folded into your sale price on the stock, and if the stock was held short-term, it's going to be short-term, and if the stock is held long-term, it's all going to be long-term. I'm
going to then ask Russell this, because when folks are doing their taxes, we're very familiar with sort of wash rules as it pertains to securities and determining, whether you can take loss carry forwards. And again, we're not all accountants here, so we're not going to get into the complexity of tax treatments and such. But Russell, one of the things in terms of if you're the seller of a put option after shares were sold for a loss, asking you about that strategy, is that something, because we've seen some extreme volatility lately. So, there are IRS rules and such that fall into that type of trade. So selling a put option after the shares have been sold for a loss, is that a good strategy?
Well, see, this is, and I think there are lots of instances that we could that we could throw out there, and I'll bet you we could get 10 tax professionals, and 5 would give you one answer, and 5 would give you another answer. I've experienced that with respect to some of the 60-40 stuff. The idea here is whether or not you define selling that put and taking on the obligation to buy shares. Is that a substantially identical position? And that's where I think there's some gray area there. If you sell and if you sell options to acquire a substantially identical position, I think you are in violation of the wash. Personally, I think you're in violation of a wash sale rule. I think you could probably find a guy that might tell you the other side of that one. But in my experience, or what I've always done personally, is I always try to err on the side of caution. And in this case, I wouldn't sell a stock to take some sort of long-term loss to offset some other tax situation, and then at the same time sell a put option. I personally don't think that's the right thing. I don't think that would pass muster if they come looking at me.
Bob, I don't know if you want to weigh in on that.
For whatever it's worth, there's actually a rule. And unfortunately, I'll take responsibility. So when we started the firm in 1983, we wanted to get some press. And what we used to do is we used to sell a stock or a muni bond or anything else and then sell an in-the-money put so that the client really didn't have to change their economics, but they could still take their loss, because the law did allow you to sell a stock and sell a put, because you're just not supposed to do anything that's substantially identical. So I gave this to a friend of mine at the Journal, who put it in the front page of the Journal, and the next day the government came out with a revenue ruling that said that if you sell a stock and sell a put, that it will not violate the loss sale rule as long as there isn't a substantial likelihood that the put will be exercised. So when you get the 10 accountants or lawyers in the room, what you're really asking them to do is define, what substantial likelihood of exercise is, and not to get into options math, but an at-the-money put has a 50% delta or a 50% likelihood of being exercised. So I think that most lawyers and accountants are actually fairly comfortable that if you sell an out-of-the-money put, that it's okay, and that if you sell an in-the-money put, you might be able to argue through delta or something else that there wasn't a substantial likelihood that it would be exercised. But I don't think anybody would be willing to sort of give you a memo or a legal opinion on that. Whereas if you sell an out-of-the-money put, they would be quite comfortable because this revenue ruling, actually doesn't define what they mean by substantial likelihood. And as it was discussed, the law itself says that you're not supposed to do anything that's substantially identical. And selling a put isn't substantially identical unless it's so deep in the money there's a high likelihood it's going to be exercised. And that's where all of this sort of comes from. Again, same thing on the 1099s. The 1099s report wash sales only if you sell and buy the exact same security in the exact same QSIP in the exact same account. So again, the client's got to be their own policeman. There's also a rule that, again, people used to sell a stock and buy a call option on the stock, and because it wasn't substantially identical, say that it didn't violate the wash sale rule, and the government came out and said, no, buying any call option violates the wash sale rule. But if you sold a stock and bought a call option, your broker isn't going to report it as a wash sale. So no one can take their 1099s and look at the reported wash sales and think that's all there is to it. All these other things override that. And selling the stock and selling the in-the-money put, I think there is a safe harbor there. And, I think whether you look at delta or whatever it may be, the simplest way is just to make sure that the put you sell is out of the money.
And that's a great explanation. You really brought it down to ground level, Bob. I appreciate that, because that's where the complexity comes into play, that the tax treatment isn't so straightforward, but when it's explained by gentlemen like the two of you, it's understandable. And, when we talk about things getting more complex but possibly having some advantages, I'm going to ask Russell this. If we look at a straight cup of Java, but now we go into the macchiato, the mocha macchiato with cinnamon, which might be the benefits of exchange traded, indexed options. You talked a little bit earlier, Russell, about Section 1256. So I'm going to ask you to weigh in a little bit about that. In your prior life at an exchange, you had sort of PM options and some of the nuances of that. So I'm gonna ask you to weigh in on that.
Sure. As you mentioned, in a previous life, I was I was at SIBO, which is a place that had a very significant interest in the tax treatment of index options, because index options actually are taxed at 60/40, which means you're not paying a full short-term tax obligation for positions in those options. And the idea behind that is that those index options are being used to hedge a portfolio, and that you shouldn't have to take a short-term gain if you're offsetting something that you have a long-term investment in. One of the most common questions that I would get along these lines was if you've got options on a broad-based ETF, like a broad-based index, did those qualify for 60/40 tax treatment? And I would hear lots of arguments on both sides of those things, where options on a broad-based ETF are basically the same thing as broad-based index options, and they qualify for 60/40 tax treatment. I don't agree with that one, but I have had tax professionals yell at me and tell me that's actually how they tell their clients to go about handling positions in. I'm trying to say this without saying a specific market name, but a broad-based ETF option, I don't think should qualify under the 60/40 mark-to-market treatment.
I think you phrased that very well in terms of walking around it. Yeah, you danced very well around that. Bob,
Thank you.
what, Bob, the advantages of the 60/40 tax treatment?
Well, so let's just back up for a second, because I again, maybe understanding where this all comes from and where it's going or whatever. So what happened was many years ago, people used to do on the commodities exchanges, futures, they would do some type of a straddle where they would take the law, they would put on a two-sided position and take the loss in 1 year and then take the gain in the next year. And the government didn't like that, and the way they decided to fix that was to say, gee, all of these futures contracts are going to get marked to market at the end of the year on December 31st. And Dan Rostenkowski, who was from Chicago and ran the Ways and Means Committee, said, geez, if you're going to make it mark to market on December 31st, everything's going to be short term, and that's not very fair to my constituents. So somehow they came up with a compromise that everything was going to be 60% long-term gain and 40% short-term gain. So that's why the law is, and that's what 1256 contracts are. Then all of a sudden, there's going to be options that trade on the same indexes that the futures trade on. And the government says, hey, if you're going to do exchange-traded options on non-equities, then they're going to get the same 1256 treatment because we don't want you to be able to do futures on an index and be taxed one way and options on an index and be taxed a different way, and that's why non-equity options get this 60/40 treatment. Now, an ETF is a stock. It's an equity. And I think we're quite comfortable in saying that an option on an equity is we know how that's taxed. It was an option on General Electric. You know how that's taxed. And an option on an ETF is nothing more than an option on an equity, whereas an option on the index that ETF may follow is a non-equity option and clearly gets 60/40 treatment. And although it's totally ridiculous that the option on an index is taxed one way and the option on an ETF that follows that index is taxed a different way, I think it's quite clear that that's what the law is. And again, understanding that this applies to anything that's a non-equity also broadens the opportunity of doing contracts that get 60/40 treatment. As an example, GLD is a grantor trust, the gold ETF, so to speak. It's a grantor trust. It's not an equity. Master limited partnerships are not equities. So a lot of people talk about the hassle of investing in MLPs and how they have to keep track of them and everything gets recaptured and blah, blah, blah. And if you do exchange-traded options in MLPs, you don't have any of those tax hassles, and everything's automatically 60% long-term and 40% short-term. So the key is that the exchange-traded option is on a non-equity, and the index is a non-equity. The ETF is an equity.
And what about carrying losses back on that? Is there anything falling within that section 1256 with carrying losses? Sort of the offset it if you have.
If you if you get mark-to-market gains and then next year it goes down, those losses are allowed to be carried back. They're the only losses that are allowed to be carried back in the tax code as it exists today as it relates to investments.
Fantastic.
But only because of the mark-to-market.
Well, you kind of
all the trade-off for being mark-to-market.
All the trade-off for the mark-to-market. And I appreciate you as a history major, Bob, bringing in that thought of how this got through, because I didn't realize that the infamous congressman from Chicago was the one who pushed this law through, and obviously a little bit behind his constituencies because we know who was based in Chicago with a lot of the exchanges.
He was one of the best friends of our industry in D.C. We could use him right now for some of the things that they're talking about tax-wise.
Well, that's a good segue, Russell, because there is sort of a new part of the podcast. We're going to get into a few questions from our listeners. We call this grounds for discussion. So a couple of questions I want to ask both of you before we wrap up the podcast. There was a question that asked, selling a CSP, a cash secured put, in a qualified account. I'll ask Bob, maybe an IRA. Are there any special tax treatments because we're doing this in a qualified account?
And you're doing what again?
A cash secured put. So you are selling a put, cash secured in a qualified account. Everything is deferred. So are there any special tax treatments?
Well, and you're selling a naked put?
Selling a cash secured put.
Yeah, I think that trading naked options in IRAs is probably something that, from a compliance standpoint, is difficult. I think it's sort of interesting because there were things that were called reverse convertibles, which were nothing more than a cash secured put, and those could be sold to a little old lady. But that same little old lady would not be approved for level 5 options trading that would be doing the exact same thing. From a tax standpoint, the gains on selling the put are short-term, and therefore, if those short-term gains could be realized within a tax-deferred account, that would be preferable. But I think you'd find most brokers wouldn't want what is considered to be a naked put, even if it's cash secured, done in an IRA, but having more to do with suitability and whether there's liabilities there and so forth and so on. And obviously a naked put they'd never let happen, but a cash secured put, maybe you could convince them that they don't have to worry about the margin part of it. But I still think you might get tripped up by the who's allowed to do a Type 5 trade in an options account.
Russell, do you want to weigh in on that?
I totally agree with Bob. It's from a tax perspective, the IRA, it's like any other kind of short-term gain, but if you're a short-term profit, assuming that it works out, but getting a brokerage firm that is going to allow you to do something like that, unless you definitely not be able to do it unless you have the capital in place to pay for the underlying if you get assigned. It makes sense in the tax-free accounts, but the brokers don't get very excited about people wanting to do such things. And every broker, it would be wonderful if across the industry we had like common levels with permissions within the option. If you're doing something at firm A and firm B, they have the exact same rules as to who they let do what. But I think across the board, selling put options, you always need probably the highest level of permissions in order to do that.
Let me ask you this question, which came from one of our listeners, about there were news going on over the last few years, and we're not going to talk about the Beltway and things that were happening, but asking you both to weigh in that there was legislation that was potentially going to happen that would have mark-to-market options on the day of that trade. And I'd ask you first, Bob, your thoughts on that. There was some discussion about it. It's kind of been put on the back burner, but your thoughts on this in terms of what was going on.
Well, I think it starts at that the government every once in a while talks about marking to market everything. And as a matter of fact, that was proposed by Representative Wyden, or Senator Wyden, who's the top Democrat on the Senate Finance Committee, last week. And what happens is that the devil's in the details of what do you do with private companies? What do you do with homes? How are people supposed to get money to pay the taxes? So then it becomes, well, let's just mark to market the things that are easy, like publicly traded stocks. And then that didn't really get anywhere. And then Representative Camp, and they're called the Camp proposals, came up with a very detailed proposal, and it was written up and made specific by the Joint Committee on marking to market just derivatives. And that didn't wind up getting anywhere. But the same people that stood up and said that marking to market unrealized gains on stocks was unfair, we're perfectly okay with it happening to derivatives. So those actually got some real traction and really got proposed and were, voted on by, the House of Representatives, whereas marking-to-market liquid stocks never got that far. But all of that seems to be back on the table again, as evidenced by Senator Wyden's proposal to mark-to-market everything that was literally released last week.
I think you summarized where we stand, and it's obviously on the minds of certain Congresspeople because of the potential of tax revenues and such. And so, well, what I ask of the two of you, and I usually do this with my panelists that are on the podcast, is to share with our listening audience something about you that they might not know. And I'm going to start with Bob because I've done a little bit of my homework, and I would ask, if you weren't in this business and you had the opportunity to do something else, I believe there is something that our listeners don't know about that is a passion you have, and it might have to do with what doesn't exist here on this planet. So I'm going to ask you, Bob, just to share a little bit about, if you weren't in this business, what you might be doing.
Well, I think it's probably more my obsessive personality makes me a collector of things. And I like to collect old books and maps and things that really demonstrate what the state of science was at the time and are laughingly incorrect now. Such as, there's an awful lot of maps and books and so forth that all explain how the Earth is in the middle and all the planets go around them. But there are also a lot of maps that have California as an island and America entirely misshaped, and the Great Lakes being connected to the Chesapeake Bay. And I find it very interesting to collect and look at those things, and it also makes me think about what someone's going to be looking at 100 years from now and laughing at us.
So if I could correctly pronounce this, you collect as an orrery? Is that the right pronunciation?
I do collect orreries, and one of the best collections of orreries and these instruments is at the Adler Planetarium in Chicago, which I'm on the board of.
See, there you go.
I encourage everyone to visit.
I knew we were going to bring Chicago and having Russell there. So I'm going to turn to Russell and ask, as a academic and having the PhD and traveling the world as you did in your prior job, but what is something that those listeners who have read some of your books and heard you speak around the country don't know about you?
Gosh, I'm a member of the Minor League Baseball Alumni Association. And the only reason I think of that one was I just got my pass for this season in the mail yesterday, where I get to go to all games for free, which is nice with all the traveling that I got to do in my previous job.
Do you get to throw the first ball out in any of these stadiums?
I've never thrown the first pitch out at a game anywhere.
Well, that could be something that we're looking forward to. And obviously
they let me get down on the field and take batting practice sometimes, though.
Well, that's pretty exciting there. All right, so
it's actually freaking embarrassing, Eric.
I wouldn't want to put myself in your shoes to do that after my Little League days.
Yeah. So there, you made me pull one out very quickly. That's the one that came to mind.
Well, listen, I want to thank Bob, Russell, thank everyone at OIC working behind the counter, even if I am the big barista up front. I don't want to forget to let all of you coffee compadres who are listening to send in your suggestions for any future Coffee with Cott podcast, if there are things you'd like to hear from us. And as we always mention, each podcast towards the M, the acronym COFFEE, C, consider using, O, option strategies, F, for your clients, F, find various, E, educational resources, E, easily at options strategize.education.org. Thank you all for listening.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.